What's up, you guys? Welcome back to the Fire Grind, and my name is Daniel, and here we talk about stock market investing. And today, what we're going to be talking about is a few of the stocks that I've been talking about recently, as there's been some major moves upwards, such as WELL Health going up 28% in one single day. We have CloudMD making big moves alongside WELL Health. Lightspeed's also up to $46 a share. Blackberry's making moves, and that's new. I've got some exciting stuff to talk about Blackberry, so stay tuned for that. As well as we've got other companies like Durham, which recently I talked about on the video that you can watch right up here. The stock has made moves upwards from $22 all the way to $27 in the matter of days. So let's jump right into this video. Be sure to stay tuned to the end of the video because I have a special announcement for you guys. Now let's get right into the video for real this time. So we're here on my TD account just looking at the CloudMD stock because on Yahoo Finance, you can't actually see the one-day breakdown. You can see the 1 hour. So you can check that out here. It kind of turns like this. So if you're looking for CloudMD on Yahoo Finance, just note that you can't see the interval of 1 day. But on WebBroker, you can see that. So last time I did a video on CloudMD, I showed you how there was a channel forming that was going downwards. And then when it broke out of this channel, ultimately CloudMD stock just skyrocketed all the way to today at $1.56. So today CloudMD went up by 4.7% or 7 cents per share. And they actually did announce their earnings today. So I'll be going over that just in a little bit. But if we look here, we can see that the RSI is in the overbought territory. So right now, if I were looking to purchase CloudMD, I would be a little bit hesitant because the RSI is a little bit high. Another thing that we can see here is that on Friday, there was a huge amount of volume. And I believe this volume was due to the earnings that were going to be coming out on Monday. So investors were just pricing in future growth or predicting that the revenues would be good. And that's probably why we didn't see as big of a pop today when they released earnings. If you guys know of any other news that moved CloudMD on Friday, you can let me know in the comments down below. But as of right now, I didn't find anything on the web. So if we go over to the earnings for CloudMD, you can see they have pretty impressive earnings when they showed they had year-over-year increase in revenue by 163%. Now, no large companies are able to ever achieve this unless they're maybe Shopify, but even then, Shopify is not able to do that. So CloudMD, because they're a microcap and their revenues are in the millions of dollars in single digit millions, they're able to increase their revenues significantly year over year. So if we look at the highlights, they have gross margins of 42%. And if we look at the margins last year in 2019, they were 50%. So they're a little bit higher last year. However, this year they dropped a bit, and I'll talk about that a little bit later on. They also closed another round of financing, and they got in $15 million in cash, which ultimately helped bolster their cash position to be about $13.8 million as of the quarter ending. Then we also can see that they have increased their network of clinics, physicians, and specialists. So they're starting to really build up the clinic side of their business, which ultimately will help promote their telemedicine. So the clinic side of the business is their lower margins, and the telemedicine side is their higher margin products. However, right now they're on an acquisition spree, trying to gain more clinics so that they can get their telemedicine products out there. As well as getting physicians into their network, they're able to put these physicians onto the platform later on in the future and ultimately grow that telemedicine platform. They also show here that they have a run rate of approximately $16 million and approximately $23 million with the expected closing of recently announced binding term sheets. So basically right now, if we take a look at their current revenues, and I think this might include some of the stuff that's already been closed since then, they have an annual run rate of $16 million, meaning that they expect revenues of $16 million per year. However, in the months after the recent quarter, they continue to do acquisitions, and that will put the run rate at $23 million. So if we assume that they earn $23 million a year and they have a PS ratio of 10, then we would put the company valued at $230 million. And typically, I value technology stocks at a PS ratio of 10 if they're a high growth company. So right now, CloudMD with their market cap of, I think, just around, let me just find that here.
2 hours later.
And with a current market cap of $171.1 million, they're still about $60 million off of the target market cap that I have if they're able to achieve a $23 million annual run rate. Other notable things to see in this quarter is that they have increased revenues by 163%, from $1 million to about $2.8 million. They also generated $460,000 compared to $340,000 in their telemedicine or their SaaS business. And this was 35% growth, and this is primarily attributed to organic growth. So the telemedicine only grew by 35%, but what ultimately contributed to the 163% growth in revenue was the revenue generated from medical clinics and pharmacies. And that was $2.3 million compared to $720,000. And this increase was primarily due to the acquisitions that the company had in the past year. So ultimately, CloudMD didn't increase their revenue by doing something in their own medical clinics. It was through acquisition. And because they increased the revenue from medical clinics significantly compared to their SaaS revenue, that's why we saw their gross margins fall from 50% to 42%, because their clinics are a lower margin business. On top of all this, their clinics incurred higher expenses because of COVID and all the necessary precautions that they had to take at their clinics. They also had a net loss of $2.76 million, which is, in line with any sort of growth company in the microcap area. And that's because these companies are trying to spend money as quick as possible in order to gain more market share. And in order to gain more market share, they have to put more money into things like advertising, marketing, as well as hiring staff for product development. So all of these things cost money, but in the long run, they'll pay off. If you're interested in reading the rest of the report, I'll link it down below in the description so you can check that out. You can see all the different highlights they've had in the previous quarter, which I'm just scrolling through right now. Now let's move on to the next stock here. We're going to look at WELL Health Technologies. And in one single day, WELL Health Technologies went up by 28%. And you guys are probably wondering what happened. Why is WELL Health moving up so much? Because, 5 days ago, it was sitting around $4.60. And they had a pullback actually from the $5.20 mark. So this stock is really making big moves right now. And the reason why we saw a huge move up in WELL Health Technologies is because they announced their US expansion. So they ended up taking a stake in a US telehealth leader, Circle Medical. And this Circle Medical company actually went through an accelerator that my startup went through called Y Combinator. And Y Combinator breeds amazing startup companies such as Dropbox, Airbnb, Stripe, and a few other ones that you can check out on the website. So here you can see Circle Medical. They're in Y Combinator's website, and they entered Y Combinator in 2015. Currently, they have a team size of 30, and they're located in San Francisco. So basically, they're a telehealth company in the United States, and right now, telehealth is pretty hot. In addition to the stake that they took in Circle Medical, WELL Health also announced a $23 million offering, which was led by Mr. Li Ka-shing. And Mr. Li Ka-shing has been an investor in WELL Health since the beginning, and I believe he's funded about 3 or 4 previous rounds. And the fact that he's still funding WELL Health Technologies means that he really believes in the company. And Mr. Li Ka-shing is one of the big billionaires in Hong Kong. I think he's maybe the second richest man in Hong Kong. So this guy's got to know what he's doing if he's continuing to invest in WELL Health Technologies. And I think ultimately that's why WELL Health Technologies continue to pop today, as they got a reinvestment from one of their best investors over the history, as well as their expansion into the US through Circle Medical. So I expect from here on out, WELL Health might have some sort of pullback because today there was a lot of investor hype, but I can't be certain about this. And I don't know if we're going to see any lower prices, but my hunch is that it will still pull back, because if we look at the previous 6 months, the stock has risen from basically the lows of $1.22 all the way up to $6.18. And that represents an increase of 400%. So I think the stock is eventually going to cool off, but right now they're just putting out news after news, which is really pumping up the stock. But right now I have a position of 100 shares, and I'm personally happy with that. I don't plan to invest at these levels right now because they are starting to seem a little bit high. If we see a pullback to the $4 level, I might consider adding more to this position, as the company market cap is still relatively small. It sits at $800 million, and I think this company could eventually be somewhere around the $10 billion mark in the next 5 to 10 years. Next, we'll move on to Lightspeed. And here we can look at Lightspeed's chart on Yahoo Finance. And right now you can see that it's been bouncing all over the place since its IPO. And right now it's actually nearing its previous all-time highs, which happened in the month of August last year. So the all-time highs for the stock was around $49.70. And I think we're starting to approach that at $47.60. And what I see here is if Lightspeed's able to break through that $49.70 level, then the stock is going to continue moving on higher. But if it doesn't, then we're going to see some sort of almost triple top here, and it might continue bouncing around at the $30 level. So I wouldn't be so quick to buy into Lightspeed yet until we get some confirmation that it's going to move any higher. On top of this, I also looked for any sort of news articles that were put out about Lightspeed to see if this could give us any information as to why the stock is popping, but there is nothing of those likes. Maybe investors are just anticipating that COVID is going to be ending soon and that a lot of these brick and mortar retail stores and restaurants are going to be able to reopen again, and ultimately that will benefit Lightspeed. Next, we have Durham, which I talked about in my previous video, and this stock is also making big moves as well. So right now you can see the stock has moved from its $11 levels right when it IPO'd all the way to $27 and even almost touching $28 today. And you can see there's this sort of pattern where it dips back down, rises up, and then dips back down and rises up again. And I actually talked about this in one of my previous videos where I gave some sort of price target for Durham, and I said the stock would likely run back up to $27. And I made that video, I believe, on this date. However, the next date it actually dropped back down, but since then, in the past 5 days, it's moved all the way up back to $27, which was where my prediction was based on technical analysis. And technical analysis is a great tool for finding buy points into the stock or sell points into the stock. However, it's not always accurate. But technical analysis is more so based on investor psychology, because when people see a stock running, they want to chase it as well. And that's why we see run-ups in stocks. And as stocks fall and start to drop, we can also see investors selling out because they're worried. That's why we see stocks continue to run up, because investors get some sort of FOMO and they want to be able to get in before the stock tops out, or if it just keeps on running, they want to see their account continue to grow and grow. And that's why on this date, when I predicted Durham would continue to go up, it's because I saw this wedge pattern consolidating here, and the stock broke out ultimately on this day and had a strong push upwards on this day here. So going forward from here, I don't think it's a great time to buy Durham personally, because I think we're nearing the end of this run up. I expect to see some sort of consolidation, maybe at the $27 level. At most, we might see it go to $30, but these are my speculations, and this is just what I feel right now looking at the stock. I may be right, I may be wrong, but only time will tell. But my personal conviction is that I'm not buying at these levels, and I'm waiting to see some more consolidation before I might add to my position. Next stock and final stock that we have here is our beloved Blackberry. So right here on Blackberry stock chart, I have it zoomed out all the way to 2016, and I have a couple lines drawn just so you can see what I've been thinking. So today I was looking at Blackberry and saw that there were some moves upwards recently. And I think it started yesterday when the stock popped quite a bit, from like the $6.50 level to the $6.80 level. And that sort of piqued my interest to look into what is happening with Blackberry. So first off, let's look at the news as to why the stock is popping. So we see here on this article from TechCrunch, Blackberry makes China push as the OS for XPeng smart cars. So XPeng is actually a recent IPO on the stock market, and this is an electric car maker in China. And I believe they are probably one of NIO's biggest competitors in China, as they have very nice vehicles and all that. And I think a lot of people are excited about this company. And if you want, you can buy into this company now because it is publicly offered. So the fact that Blackberry is making its push into China means that it's got massive market opportunity ahead of it, because the Chinese market for electric cars is huge. It's a lot bigger than the United States. So if Blackberry can get its software into these cars, this could be a major opportunity for Blackberry going forward. And ultimately, that's why we saw the stock starting to break out here. So if we zoom in a little bit, you can see that there is some decent price movement. There are a couple major green candles, and ultimately Blackberry pushed above its 200-day moving average, which is this green line. On top of that, we can see that there is a channel that's been, a pretty strong pattern for the past 2 years since 2018. You can see that it touched the top and the bottom of the channel 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 times. And the 13th time, it's finally starting to break out with a pretty strong candle. We did see a recent breakout back in 2019 in March. However, it didn't continue going up, So I wouldn't be so quick to buy into Blackberry yet until we see a bit more confirmation for Blackberry going ahead. I think maybe if it hits the 850 level and continues to go up steeply, then we can see there's a lot of good investor sentiment towards the stock, and it might be good confirmation to buy into Blackberry then. But as of right now, I'm still holding on to my shares. I haven't sold any. I still hold some in my WealthSimple account as well as a private account. And I think ultimately Blackberry, to me, is a good long-term play because software security is going to be even more important going forward. As autonomous vehicles become more mainstream, the risk of being hacked as an autonomous vehicle or a network of vehicles, this could be very detrimental to an entire city or an entire country. Because if a hacker could come in and take over the entire, Toronto grid, for example, and hack into all those cars, it could essentially stop all business activity in Toronto. And this is how we can see cyber warfare playing out in the future. So that's why Blackberry software is very important to electric car makers as well as other software providers. And Blackberry now has a significantly lower PS ratio compared to the competitors like CrowdStrike. So I think Blackberry, because it has a tarnished name from its hardware days, that's why investors aren't as interested in the stock as other high growth stocks that are coming out of the US. But I think this could be a sleeper stock just like AMD was, where AMD used to be trading at $2 per share, and today I think it's somewhere around $80 per share. And Blackberry is trading at $7 per share. But back in its glory days, if we go back there, you can see that it was trading at, I think, $149 per share. So we may see a comeback in Blackberry here, and this might be the push to do so. And that's why I'm hanging on to Blackberry for my dear life. Thanks guys for watching, and as always, click that like button as well as hit the subscribe and the notification bell for future videos. My next video will be coming out on Thursday, where I have something very special for you guys. I actually did an interview with the CEO of a very good food company recently, and I've got some important information to announce to you guys who are interested in investing in this company. So the format of the video will be some question and answer, as well as I'll be doing a lot of commentary on it. You'll definitely not want to miss that because this is one of my favorite microcaps that I'm invested in right now, and I think that there are big potential gains in the future. Keep up the grind and have a great day.